This video, we're going to work exercise 9-6A. And it's going to show that the impact of taking on debt, even if you borrow and you have cash because of the debt. So in other words, in this problem, we borrow $72,000. Liability goes up by $72,000 and cash goes up by $72,000. What's that impact on the current ratio? So in this case, year 3 is like 2023, if you want to say. Friends and companies, beginning current assets are $900,000, current liabilities are $360,000. On July 1, they issue a short-term note. Basically, they went to the bank, borrowed money for $72,000 cash. The bank, they borrow money, the cash gives them a check for $72,000. They deposit the check into their checking account. So now cash has gone up $72,000, and their liabilities have also gone up $72,000. Well, just to drive everything home, letter A says compute working capital before and after issuing the $72,000 note, and B says calculate the current ratio before and after issuing the note. I'm going to cheat and use the solutions that they give the instructors. You know, when you're a student, the solutions will be so much more handy, right? I mean, really, you understand that. And then when you know the material, they give you the instructions. That's kind of backwards, but that's the way it is. All right, so anyway, so all jokes aside, I normally like to just work these myself and not use the solutions, but there's no sense in reinventing the wheel. This one's good enough. All right, so before we had 900,000 and 360. You can, look back at the problem of the book if you want before you watch the rest of this video, so you could pause and then read the problem and look again. But anyway, so as you recall, the problem says from the book that the current assets are 900,000 and current liabilities are 360. So 54,000 is working capital. Then after they borrow $72,000, again, they put the money in the checking account, 972,000. So assets went up by that same amount that they borrowed, 972. And then the current liabilities also went up by 72,000. It's now 432. So look what we have. Working capital is the same. And I thought about saying, working capital is the same, 540, and not even working that one with y'all. But I think it's important to note that that is exactly what happened. The liabilities increased by 72,000. Assets increased by 72,000. There should be no change in working capital. However, the current ratio does change. One thing for sure, I know by looking at this, 540, we got positive working capital, right? I know the current ratio is going to be greater than 1, period. Okay? Period. However, the denominator has gone up. And the numerator also obviously went up, right? When we take current assets as the numerator, current liabilities as the denominator. But the impact of the liabilities, the denominator, even though it's the same amount of increase on both sides, or in this case right here, both sides, right, with the dividing symbol here in the middle, was the same. The impact on the ratio is not like working capital. It does change. So 900,000 divided by 360, the pre-borrowing current ratio is 2.5 times. The current ratio after, even though, here they are, before and after, we just did that, 972 divided by 432 is 2.25. So even if we borrow money and we put all that money in the bank, current ratio will go down. Okay? And that's how that works. If we had borrowed the money, and just think about this, if we had borrowed the money and paid bills, so this is 900,000 here, but we still owe the 432, like a company's borrowing money short term to pay bills, that would have really dropped even more. So it dropped and they kept the money. Imagine if the company's burning through cash, doesn't have enough to pay its bills, and borrows money short term. Current ratio would really drop. All right, so that's the video for exercise 9-6A. If you have any questions, email me.